A bank just closed someone's credit card. 6 years old, $6,500 limit, no warning. They found out when the app said account closed. And here's a part that should scare you. They didn't do anything wrong. They just didn't use it enough. Banks are quietly pruning old accounts right now. And when an old one dies, it doesn't just disappear. It can spike your utilization overnight and start a 10-year clock on your credit history. In the next few minutes, I'll show you exactly why they do it, the 5-minute move that keeps your oldest accounts alive, and the one thing people get dead wrong about closing a card. Let's go. Hey, I'm Flo, and this is the Credit to Capital Blueprint, where we turn personal credit into real business funding. New here? Hit subscribe and turn on notifications, because this is the stuff the banks don't hand you a manual for. Okay, let's get into it. So first, why would a bank close an account you never missed a payment on? Simple, an unused credit line is a liability to them. They're on the hook to lend you that money they set aside capital for, and they make nothing if you never use it. So when they tighten up, the deadweight accounts are the first to go. Now here's what I need you to hear, because this is where people get it wrong. There is no magic number of months. You'll see people online swear banks close after 12 months of no use. It's not a rule. Some issuers close after 6 months, some after 18, some basically never. And it changes, and they rarely publish it. Some banks don't even close it first. They quietly cut your limit first, which does its own damage before the account is even gone. And it's happening more, not less. People are reporting it constantly. A 6-year account with a real limit, gone with no heads up. Someone else lost a 7-year card with a $20,000 limit. Same reason, they just weren't using it. These aren't tiny starter cards. These are old, established accounts, the exact ones you most want to keep. So the takeaway from beat 1 isn't memorize a rule. There is no rule. The takeaway is any old account that sits totally unused is a target. Every single one of them. Now, what does it actually cost you when an old account closes? And this is the most important beat in the video, because almost everyone gets it wrong. The myth is my old account closed, so my average age of accounts just cratered and my score tanked. That's not what happens. Here's the truth. When a card is closed in good standing, it does not vanish from your report. It stays for about 10 years, and during that whole time, it still counts towards your average age of accounts on the score banks actually lend on. So closing it does not give you an instant age hit. So what does hurt? Two things. One, and this is the fast, painful one, your utilization jumps. That closed card had a limit. The second it's gone, your total available credit drops, but your balances didn't. So the same debt is now a bigger percentage of a smaller number. Utilization is about 30% of your score, and it moves fast. Way faster than account age. Let me put real numbers on it, because this is the part that should make you set this up today. Say you're carrying $4,000 in balances across your cards, and you've got about $13,000 in total limit. That's around 31% utilization. Not great, but not a disaster. Now that $6,500 card gets closed. Same $4,000 in balances, but now you've only got $6,500 in total limits. Your utilization just jumped to over 60% overnight. You didn't spend a single dollar. The bank cut your available credit almost in half, and your score takes the hit for it. That's why a closed high limit card can drop your score more than the age ever would. 2. The 10-year clock. That closed account keeps counting for about a decade, and then it falls off completely. That's when the age hit lands, years from now, and on top of it, you've permanently lost a trade line that would have just kept getting older and stronger if you left it open. So put those together. Losing an old account isn't a catastrophe today because of your age. Your age is mostly fine for 10 years. It's a problem because of utilization right now and because of what disappears a decade from now. That's the real damage, and it's exactly why the move isn't to panic about closing. It's to keep the account alive so it never gets closed in the first place. Okay, the fix, and it really is about 5 minutes. The whole game is make every old account show a little bit of life on a schedule so it never reads as dead. The cleanest way, put one small recurring charge on the card and set it to autopay in full. A $5 streaming plan, a phone bill, a subscription you already paid. It runs every month, it pays itself off, and the account looks active without you thinking about it. 2 honest rules on that, because I'm not going to oversell it. 1, this reduces the odds. It is not a guarantee. A bank can still close an account, and this stacks the deck in your favor. It doesn't lock the door. 2, it only helps if it's paid in full every month. Carrying a balance to keep it active is a myth. You'd be paying interest for nothing. The charge keeps it alive. Paying it in full keeps it free. And if you got an old card you really can't put a subscription on, the floor is simple. Use it at least once a year. Buy a coffee, pay it off. Once a year, minimum on every old account. That alone kills most inactivity closures. Now, which accounts gets this treatment first? Protect your oldest accounts and your highest limit accounts before anything else. Your oldest card is the backbone of your credit age. You keep that one open forever, even if the limit is small. Even if you never really use it, put $5 on it. And your highest limit cards are the ones that will spike your utilization the most if they close. Old and high limit. Those are the 2 you defend. Last piece, and it's the flip side. A ton of people do the opposite of keeping accounts alive. They close old cards on purpose, thinking they're cleaning up or protecting their score. Usually that's a mistake. Remember B3, closing doesn't help your age, and if the card has a real limit, closing it spikes your utilization. So closing to protect your credit usually does the exact damage you are trying to avoid. What you keep open, your oldest card, always. Any high limit card and any card at a bank you'll want more credit from later. Closing signals you're done with them. What's actually fine to close? A newer card with a fat annual fee you're not getting value from. And even then, only if your utilization can absorb the loss limit. Here's the whole thing in one picture. Say you've got 5 cards averaging 4 years old, and your oldest is a 6-year card with a decent limit that you stop using. Do nothing, and one day the bank closes it, your available credit drops, your utilization jumps, and in 10 years, your age takes a hit too. Or you drop a $5 subscription on it, set autopay, and forget about it. Same card, same 5 minutes a month, but now it stays open, keeps aging, keeps padding your available credit, and is there when you actually need to lean on your file to get funded. That's not a hack. That's just refusing to let your credit quietly rot while you're not looking. So if a bank has ever closed a card on you out of nowhere, now you know why, and now you know the move. There's no magic number of months. There's just this. Keep your old accounts showing a little life. Protect your oldest and your highest limit cards, and stop closing things to protect a score you're actually hurting. Here's your next step, and I made it dead simple. I built you a free Keep Your File Alive checklist. It lists which accounts to protect first, the exact keep alive cadence for each one, what's safe to close versus what you defend, and a quick way to project what a closure will do to your file. It's a whole routine on one page. The link is in the description and pinned in the top comment. Grab it. It's free. And if you want to know your single biggest blocker before you do anything else, sometimes it's not an old account. It's your utilization or an old late. I've got a free 90-second fundability check too. Comment the word alive and I'll send you the checklist or score for that blocker check. One more thing, that checklist is the starter routine, the majors of keeping your file healthy. The deep version, which specific issuers close fastest, which ones cut your limit first, the per card keep alive cadence, and your personalized which of your accounts to protect first read. That's what I go through with the email list and when you reply audit. So grab the free one, then get on the list, because that's where the full garden lives. This content is for educational purposes only. Always follow up with your own research before making any financial decisions. Whether and when an issuer closes an inactive account is issuer specific and changes. Keeping an account active reduces the odds. It doesn't guarantee anything. Keep that momentum. I'll see you in the next one.